Doctors are very unique when it comes to their finances. They sometimes come with a high degree of student loan balances, but they also have at the beginning of their career this period of time, sometimes 3 to 6 years, where their income is significantly less than the rest of their career. When they finish training, they go on to be attendings and have this post-residency boom where their income jumps. And not to mention, there's a ton of life transitions happening during this time. And so I've designed this presentation series to be designed for doctors in training to provide you the financial education to be more clear and have financial clarity on your finances. And so to jump into this, I want to start by sharing a story. Let's just call them Alex and Sammy. Alex and Sammy, they finished residency and decided to move out to California for their jobs, and specifically Southern California, high cost of living area, but both physicians, one was an internal medicine doctor, the other was a dermatologist, earning very good incomes, but they had student loans. They were working for a group that was technically a private group, and they were unable to qualify for any sort of forgiveness. So they wanted to pay off their loans, and when they were working with us in this situation with their student loans, the environment for interest rates was really low. So it made sense, and it was the best move for Alex and Sammy to refinance their student loans. And so they did. They refinanced their student loans, got their interest rates cut in half, down to about 3%, and so effectively reducing the total amount of interest. And again, it was the right financial move for them. But then came along in November 2022, the Department of Education created a new policy and published a new policy that pretty much expanded who had access to public service loan forgiveness. Yes, you work for this group that is under these new policies, a qualifying employer, and yes, you would have had access to public service loan forgiveness, but you took this route that in the time that we were talking about and planning for your student loans, you did what was best. Unfortunately, they no longer qualified for public service loan forgiveness, and now being in 2025, they would have had their public service loan forgiveness issued had they stayed in the in the federal loan system. And obviously, hindsight's 2020. Nobody knew that was going to take place 4 years after they finished residency, but that is really the situation that you're up against. Always changing, new policies coming into play, public service loan forgiveness, what is going to happen to that plan, new repayment plans, all of these things are impacting you while in residency, and this is what you're up against. This is the changing landscape that you have when it comes to your student loans. And so in today's discussion, we're going to go over student loans. I want you to know the types of student loans that are out there. I also want you to know what the repayment plans that you have access through federal student loan system, and then also what types of forgiveness are available. Then from there, really the question that you're probably asking for yourself is, which route is best for me? And so to get this started, I like to think about student loans in two fashions, in two ways to go about your student loans. The one route is forgiveness, and with forgiveness, you want to pay as least as possible. The other route is paying off your loans, so paying it down to zero. And with that route, you're wanting to reduce the interest cost with those student loans. So to set that framework and with those two pathways in considering your student loans, the types of student loans that are available and that you probably have, a majority of your loans are federal student loans. But there's also private student loans. So it's really important to know what private student loans mean and are, and how they may play in your picture and your finances in the future. So I like to think about private student loans being close to auto loans. You have a bank or lender who issues you this loan, and you are now required to pay them back on a schedule. Most of the time, that schedule is going to be very fixed. They do sometimes offer residents a little bit of a discount and some flexibility during their training years. But in general, think about it like an auto loan where you have your balance you have your term, you have your interest rate, and then you have your monthly payment. And when you finish that term, you're going to have that student loan paid off. Generally speaking, with private student loans, there's no access to federal protections. So the forbearance that you've experienced over the last few years with the SAVE plan, that wouldn't be something you have access to. Debt discharge, this is another thing. If you were to pass away, private student loans, depending on how those loans are drafted up and the underwriting is written, you may not get those debts discharged if you passed away. And then also forgiveness, that's pretty clear. You're not going to get your private student loans forgiven, but it's important to state. And then really private student loans, I guess emphasizing on that story, it's so important for you to know if you have federal student loans, if you refinance, it is a one-way street. Once you're in private student loans, you have that requirement to pay that balance down. Now, to switch gears into the federal student loan realm, really thinking about federal student loans, you probably have one or all three of these. Most likely you have a majority of your loans in unsubsidized loans. Now, not spending too much time on the different types of federal student loans because that truly, you don't have any control over that anymore. It's in the past. You have what you have. What I want to spend time focusing on is what control arms you have with your student loans. And so in the federal student loan system, you have these income-driven repayment plans. And this is huge for you during residency because your income, like I stated at the beginning, your income is lower than what it's going to be for the rest of your career. And so income-driven repayment plans, not all of these plans are appropriate for everyone. So it's very hard for me to give a blanket statement for which one is best. Although typically PAYE and IBR, the two that are bolded there, those are probably going to be the best plans available to you as a resident. But there are situations where other plans could make sense. To mention SAVE, that one is phasing out, and also I'm unsure whether that's a qualified income-driven repayment plan for the purposes of PSLF. So SAVE and RAP, Repayment Assistant Plan, that is a newer one. Those two are on the outskirts. The focus for you, I would say, to start looking at PAYE and IBR as the plans for you during residency. But before any recommendation is taken, I'm not giving any advice here on what plan you should be on, but for you to understand, okay, here is the plan options, here's what the differences are. With these plans, they calculate your monthly payment based on income. And so income is defined as, in some plans, discretionary income, and other plans, it's all income. So it's intricate with that. But in PAYE and IBR, new IBR and old IBR, I'm terming those together, you have 10% of your discretionary income, and then in old IBR, it's 15% of your discretionary income. The eligibility, this is interesting for you if you're a new borrower after July 1st, 2014, meaning you had no loans issued to you before this date. So July 1st or after, that's when you started borrowing your student loans. You would be eligible for new IBR. If you had loans given to you before that, you would qualify for old IBR and PAYE. And so the eligibility piece to the puzzle is really dependent on your situation. Going back to that, dependent on your situation, is thinking about, okay, here's my situation now. PAYE makes sense for me now, or new IBR makes sense for me now. But what about when my income increases? Or what about if I get married and my spouse has income that's attending income? My tax return is showing $300,000+ of income. What makes sense for me now? That gets into the weeds of determining, okay, payment amount, 10% of discretionary income. There's some tax filing strategies like married filing separately, or reduction of income through pre-tax contributions to retirement accounts. All of these things need to be factored in and help you determine what plan makes the most sense for you. And so to go one step further with comparing these IDR plans, the payment cap, this last section where I'm comparing plans here, the payment cap is really important for physicians because when you go from residency to attending income, you'll have this year where your income is commingled with residency income and attending income. Recertifying your income means you're telling the student loan processor what your income is and whether you qualify for these student loan repayment plans. But also, it's recalculating what your monthly payment is. And the payment cap is super important because that allows you to pay what would have been the lesser of the 10-year standard repayment plan, or what the 10% discretionary income is, or 15% discretionary income is. The payment cap isn't necessarily important for you during residency, but it is very important for if you're a dual income family, but also when you switch jobs and start making attending income. And so Pay and IBR, yes, they have a payment cap, whereas the Repayment Assistance Program, RAP, does not have a payment cap, nor does SAVE. So those two factors are important for you in the future. So let's look at what that truly means for you. You're a family size of 2, so you're married, or you have a child, you and a dependent. You have an income of $73,000. Your student loan debt is $300,000, and your interest rate is at 7.5%. What does this mean for you? Based on this calculator on Student Loan Planner, you actually have this factored out for you. Under the new IBR, you're going to have the lowest monthly payment of potentially $344 per month. Under the old IBR plan, new IBR and Pay, the 10% discretionary income calculation, that gives you a monthly payment of $344. Under the Repayment Assistance Program, $426. Old IBR, $516. So breaking it down to compare, okay, this is what it looks like to make payments on a monthly basis based on residency income. However, what does that look like when I do switch and start earning attending income? So let's say you're married, family size 2, income is now $500,000, student loan debt, same amount, $300,000, 7.5% interest rate on your debt, and your monthly payment, you can see, increases. But what's really interesting, and it goes back to comparing the income-driven repayment plans, that new IBR, Pay, and old IBR match what the standard 10-year repayment plan is. $3,561. That's what you're paying. Like I said, it's the lesser of the income-driven repayment plan or the standard 10-year repayment plan. And so that's where the payment cap comes into play. And then where it doesn't come into play is the RAP plan. You can see that monthly payment is actually more than these other plans. Income-driven repayment plans are really important for you to know and pay attention to throughout your residency, but also as you make this transition to be an attending. So switching to the next point of what you need to know. You need to know about the forgiveness routes. Typical forgiveness routes include standard forgiveness. The other route includes public service loan forgiveness. Focusing first on standard forgiveness, the main points here, it takes 20 to 25 years, 30 years under the RAP plan to reach this forgiveness. But even more importantly, this forgiveness is a taxable event. So when you get that amount forgiven, it is taxable to you. Now, chances are your income is going to be high enough to where your forgiveness amount is low, if any, because after 20 years, you'll have paid off the loan balance. But on the flip side, public service loan forgiveness, this is what makes it so different. 10 years or 120 qualifying payments, and it's not taxable. That's a huge difference in the forgiveness. So taking it one step further, what standard forgiveness looks like. This is a situation where the individual had income that was less than $200,000 a year and projected to keep that income throughout their career. They had a current student loan balance of upwards of $500,000, and if they were on the pay plan, their monthly payment would be about $1,100. After they reached that 20-year time frame, meaning from the time the debt was discharged to them and they paid that 20 years, they would have a balance still on that loan of $710,000. So interest subsidy not there, interest is accruing, the balance is growing, but they're making this monthly payment. Over that 20-year period, they would have paid a total of $240,000. that would have been what they paid towards a student loan. But they have the tax bomb, $710,000 forgiven that they have to pay taxes on. They're looking at upwards of $290,000 just in taxes on that forgiveness amount. So in total, when you add the tax payment plus the payments that they made over the life of the loan, they're looking at a cost of this total student loan of $530,000. And that's what you have to think about when you're factoring in standard forgiveness. Yes, I'm paying a low monthly payment, but I'm also having to pay a huge tax bill when this amount is forgiven. Now, I mentioned when I was talking about standard forgiveness, most physicians won't qualify for much standard forgiveness because their income will be so high that they'll have most of the loan paid off. They'll make more of a dent in the principal over that time period. But this is what it looks like if you pursue standard forgiveness and what you have to be prepared for. The more important, more relevant topic for most physicians is PSLF. And so to set the frame and stage for PSLF, I don't think PSLF is going anywhere. It's federal law, and it requires basically both sides of the aisle to be on the same page about this. And it's been attempted in the past that PSLF be repealed, but past attempts have failed. And also, even in those past attempts, they've tried to grandfather in the current borrowers that are pursuing PSLF. So even if it is the case where PSLF is again up on the docket to be repealed, I truly believe that you'll be grandfathered in just based on the previous attempts. And so with that stage set, PSLF, how do you get there? First, you have to have qualifying loans, and that is direct subsidized, direct unsubsidized, direct loans. You could consolidate to get your direct consolidated loans. And so the first step is having qualifying loans that are direct. So direct student loans. If you don't have them, you may consider consolidation. Second, work for a qualifying employer. This is unique. It's changed, like I mentioned at the top of the presentation, it's changed for California physicians and Texas physicians. If you work for Kaiser or Sutter, this gives you now the opportunity. Yes, you're working for a group, technically a private group, employed by a nonprofit hospital. You technically work now for a qualifying employer. And so work for a qualifying employer, but you have to also make qualifying payments while working for that qualified employer. And so a qualifying payment, what that means, it has to be a payment on an income-driven repayment plan or a standard repayment plan, the 10-year standard repayment plan. And it has to be an on-time payment. So that's something to keep in mind. With all of that, you have to do steps 2 and 3. You have to repeat that 120 times. It doesn't have to be consecutive, but it does have to be qualified 120 times. So if you take a 3-month gap year or 3-month gap between residency and your attending position, you still have to make payments, but you won't have those payments count towards PSLF. And then finally, once you get to 120, you have to submit your final PSLF form. And that will allow you to reach PSLF and have your student loan balance wiped out to zero and possibly see your net worth go from negative to positive. So that's a lot, but to boil it down for you, while you're in residency, what to focus on during residency, here are the 3 things. First, most importantly, is your income-driven repayment plan. Get on an income-driven repayment plan that is qualifying. So pay new IBR if possible, new IBR. Make on-time payments to those income-driven repayment plans, and also certify for PSLF. Given that certification at least once during residency and also at the end of your residency so that you don't have to 2 years down the road at your new job go back to your residency program and try and get that certification done. It's really best to get in the habit to do this annually so that you know what you're tracking for with your PSLF credits. Now that doesn't necessarily help too much in terms of those that know for certain they're going into private practice. But Like I mentioned at the beginning of the call, there is so much going on with federal student loans. Even if you're not pursuing PSLF, I know a lot of this talk is geared towards that and making sure you're prepared and ready for it. But even if you're not pursuing public service loan forgiveness, the ability to lower your monthly payments during residency and take the time and have the federal provisions and protections on your student loans as you figure out what you're going to do with your career, and even maybe after that first year of your new attending job, maybe you switch employment positions and end up working for a qualified employer. It really is that decision of leaving the federal loan system for a private loan. That's a big thing to think about. And don't worry too much about it during residency, because right now you work for a qualifying employer. So the best thing to do is focus on these 3 things, and then once you finish residency or fellowship, then that's when you face that bridge. But before I talk about what to do, I guess, after residency and what to focus on there, I want to just give a caution towards temporary relief. So there's deferment and forbearance offered to doctors in residency. It's really important to know that I think the most important thing, you're losing out on PSLF credits, meaning you're working for a qualified employer. You could be paying the lowest amount that you're ever going to pay on these student loans, sometimes a few $100s on your student loans per month. But the other things to think about, interest continues to accrue. So if you're not working for a public service loan forgiveness qualifying employer, interest accruing is a big thing that you would ideally want to prevent. As I mentioned, the 2 routes, forgiveness as one route, paying it off as the other. With the forgiveness route, it's most ideal that you're paying as least as possible so that you have as much as possible forgiven. But if you're not pursuing PSLF and doing standard forgiveness, it's super important that you're preparing for that tax bomb at the end of the 20 or 25 years. But thinking about paying as least as possible, the way to do that, income-driven repayment plans and reducing your adjusted gross income. So reduce AGI. When you do that, reducing your adjusted gross income, that then impacts your income-driven repayment plan calculation. And so there's a couple ways to do that. And I think at that point, when you're looking at that and really trying to define for yourself ways to do that, reaching out to a student loan professional to help you identify that and look for planning opportunities is a fantastic use of an investment in yourself and your future. So that's forgiveness. The other route is paying it off. So paying it off, you ideally want to be paying it off with the least amount of interest paid, because that's money you're paying to somebody else that you don't get to keep. So the way to do that is to consider refinancing. So federal student loans may have a better interest rate than the private student loan market. It depends in the private student loan market, depends on your credit score. And it also depends on the interest rate environment. So right now we're in an environment where interest rates are pretty competitive. Private to the federal student loan side, it might be a little bit less on the private side. But again, that's the decision going back to, am I going to pay it off? So the other thing on reduce interest costs, you have interest rate and term. Ideally, the term, you're going to have a 10-year or less term for your private student loans. Anything further than that, you end up paying more than you probably need to. Really, you're definitely paying more than you need to, but 10 years is doable for most physicians and their salaries that they get as a new attending. And then interest rate, I like to remind clients that I am working with that have private student loans, the interest rate can be fixed, it could be variable. And so to define, do you have a fixed rate student loan or a variable interest rate student loan? Fixed rate student loans are much easier to plan with. What your monthly payment is, you don't know with variable rate if it's going to increase or decrease due to the interest rate environment. So to continue to keep a pulse on the interest rates may mean that you have a refinance opportunity for a lower student loan rate, interest rate. So just like a mortgage, same thing with a private student loan. If you could find a lower interest rate out there, it's probably worth refinancing to save yourself that cost and interest. And then last thing on the interest rate side in refinancing, if you have let's say a 10-year private student loan, You've paid down over 3 years. The leftover term is 7 years. Let's say you find another loan that has a lower interest rate through another lender, another 10-year term with a lower rate. Yes, the rate is lower, but you've now expanded and extended the amount of time you're paying off your student loans. And so you want to think about the term structure. Can you get a new term like 7-year or a 5-year with that lower interest rate and now start chipping away even more at that student loan balance and not ultimately paying more in interest than you need to? And when it comes to your student loans, so the biggest thing, the hurdle, the brick wall that you need to pass through is making that decision for yourself, for your family. Am I pursuing this route of forgiveness, or am I committing to this route of paying it off? So finally, when you're finishing training, what to consider? If you're pursuing PSLF, these are the 3 things. Make sure you're on the correct income-driven repayment plan for your family and for yourself. Lower your monthly payment amounts by reducing your AGI, and continually, at least annually, submit your Form PSLF. If you're paying off because you're going into private practice, again, consider refinancing and aim to pay off your student loans in less than 10 years. If there's any questions, I would love to continue talking to you and help guide you in this direction of dealing with your student loans during residency and post-residency. Follow me at Fallbrook Fi. Feel free to book a call with the link in my bio. I would be happy to chat with you for free to talk through this. Thank you for your time, and best wishes to you.